Welcome everyone, and thank you all for joining this webinar focused on how to best create value from the divestment of non-core businesses. I'm Graham Smith and I lead the EMEA M&A team at AlixPartners. This is part of a regular series of short webinars we'll be hosting on topics that are timely and relevant to our clients. Whilst M&A volumes have fallen due to the impact of COVID, corporate M&A teams have still had their hands full. As this crisis has progressed beyond its initial critical phase, more and more companies are taking the opportunity to take a fresh look at their operational portfolios and question what the size and shape of their businesses should be going forward. From our discussions with these teams, we're finding a greater willingness to actually take tougher decisions to ensure their businesses are fit for the future. This leads us to believe there will be an increase in businesses looking to divest of non-core divisions. In light of this, we prepared this presentation to provide our perspectives at AlixPartners on how best to maximise value and increase confidence of success on these disposals. This is not about the disposal of must-have assets where buyers will be fighting it out no matter what. This is about businesses where time needs to be invested to develop the equity story, sell the upside, and address the complexities of the carve-out ahead of launching a sale process. We'll look at the overall market context. What are the key issues that arise that can cause an M&A deal to fail? And then set out what, in our experience, should be done to ensure success. The webinar is due to run for 30 minutes, and there is a Q&A function for you to raise any questions you might have, and we'll respond directly to you on these questions afterwards. So moving on to the next slide, the M&A team at AlixPartners covers all aspects of the M&A process, from lead M&A and debt advisory through operational and IT due diligence, carve-out and post-merger integration advice, and also merger clearance support. As I've mentioned, I'm Graham Smith and I have over 20 years of experience, including leading a large number of complex divestment processes. I'm pleased to be joined today by my colleagues, Nick Wood, who specialises in leading non-core disposals, and Philip Marquand, who specialises in driving operational improvements and leading carve-out transactions. And with that, I'll hand over to Nick to provide the market context of this session.
Thanks, Graham, and good morning, everyone. As we know, COVID has had a significant impact on businesses across all industries and geographies. And whilst there's been a range of severity, from a temporary reduction in volume in Q2 of this year at one end of the scale, to the ongoing challenges of industries such as travel, leisure and hospitality at the other end, no matter where your business sits on that range, markets have changed and so too have customer needs. As a result, there's a need for review of business portfolios, not only to ensure that management bandwidth and capital are being prioritised to deliver the greatest returns, but also to ensure that the business portfolio meets the needs of the customer over the long term. So recognising this, many corporates have or are in the process of reviewing portfolios and being forced to apply ruthless prioritisation of resources. This in turn is leading to the identification and divestment of non-core businesses, either as a mechanism to increase liquidity in the short term, or to reallocate capital to the core areas of the business. And as we can see on the next slide, this is occurring across all industries, from food manufacturing, household care, consumer, insurance, industrials, etc. And the scale of restructuring or divestment being pursued is broad, to the extent of which is being dictated by many factors, whether that be a degree of change in a particular market or geography, liquidity needs of a business, or indeed where they are in the evolution of the corporate strategy being deployed. Now, as we can see for the examples on the page from announcements over the summer, these reviews are ranging from individual businesses or business units, such as Philip's review of its domestic appliance business or Reckitt's disposal of personal care assets, to more wholesale changes such as the change in strategy from Aviva to focus on the UK, Irish and Canadian markets, which has triggered a multi-company disposal programme across Europe and Asia Pac. So boards are starting to take decisive action to refocus resources and exit non-core businesses. And as they do this, it's critical to consider the current M&A environment, the challenges that COVID has brought to it, and how best to plan and mitigate these risks to ensure value is delivered from non-core divestments. So if we move to the next slide, we can have a look at the deal volume and value to help understand the current M&A environment. As you can see from the chart on the left, we saw a significant fall off in deal activity in Q2, particularly as the pandemic gained momentum and many countries went into lockdown. Many processes were put on hold, trading performance was impacted, investors and lenders withdrew from the market, either to focus on shoring up existing portfolios, or simply put off by the increased level of uncertainty. Now in Q3, we have seen a degree of rebound in deal activity, partly driven by distressed M&A, but also processes that were put on hold in Q1 and 2 being restarted. However, the market remains subdued. Valuations are volatile, debt issuance for new deals remains low, and deals are taking longer. As you can see from the pie chart on the right-hand side from a recent survey taken, over 67% of respondents felt deals were taking longer than pre-COVID. Now, interestingly, over the course of last year, we had actually started to see a lengthening of transaction timelines, but this trend has definitely been accelerated during COVID. Largely driven by the increased uncertainty, buyers are more cautious, and as a result, deals are under more scrutiny, longer due diligence periods, etc. And our experience shows that when deal timelines lengthen, there is an increase in the percentage of deals that fail or risk. And this is indeed another feature we're starting to see more of in the market. So why are deals failing? There's a whole host of reasons why deals can fail or stall, whether that be business or deal specific or market related. It's critical to identify and assess potential risks in the preparation phase, because while some risks cannot be avoided, most can be mitigated through preparation and planning ahead. Now, we've set out in this slide a number of deal risks, but in the interest of time, I'm just going to highlight two key areas that are critical to deal success. Firstly, in the early stages of a sales process, a key goal is to secure buyer engagement. In the current environment, with increased levels of buyer cautiousness and competition for investor attention, this can be more challenging. Now, the key to success in this regard is presenting a well-structured business plan that clearly articulates the reason for the business to exist, how it creates value, the growth opportunity, and the industrial logic for the acquisition must be clear. And in this initial engagement with buyers is where value is established. It sets the tone for the entire sales process. So this first phase is key. The second area is the due diligence process. As a deal progresses, it's critical to build buyer confidence in the business and continue to drive value. To do this, we set two objectives. Firstly, the ability for the business to continue to perform well through the process and deliver the benefits of the performance improvement initiatives established in the early stages. And secondly, the ability to support buyers through a well-structured due diligence process is key to defending value that has been established, but it also provides the ability to build momentum and drive the process. And by delivering on these process objectives, it not only ensures that process timelines can be controlled, but it also helps enhance value through building competitive tension amongst bidders. Now, happy to take some questions at the end on some of the other areas, but the key takeaway here is, in order to maximise chances of delivering a deal, vendors must avoid surprises, ensure financials are robust, diligence is efficient, and momentum is maintained throughout the process. The final risk I wanted to highlight is that of leaving value on the table. So we move to the next slide. A common mistake we often see It's vendors moving immediately from identifying the business as non-core, writing an IM and launching a sales process. Now, the reality is whether the target is an efficient, high-performing standalone business or it's a carve-out from a wider group, vendors often overlook potential value sitting in the business. This is great from us when we're advising on the buy side. We're able to help our clients identify upsides achievable post-acquisition, but it's not so good for vendors. So as the slide highlights, areas where we often identify value being left behind can range from unexplored performance improvement opportunities, losing value through excess working capital, or even surplus assets that are not required in the business, or even worse, not valued by buyers. Now, these and other value items should be identified and addressed before the sales process is launched to avoid leaving value on the table, but also by investing time in this assessment up front, it provides the opportunity to maximise a credible and deliverable pricing EBITDA from the sales process, but also improve cash generation pre-exit. So in the next section, we'll explain the key elements of this pre-exit assessment and how it's core to our recommended approach to divestments. But to sum up the current market, we have seen a degree of rebound in M&A activity. However, it remains subdued. Buyers are cautious, deals are under more scrutiny, and valuations are volatile. So in this environment, how do shareholders that are seeking to refocus resources ensure they maximise value and deal security in their disposals? As the next slide shows, the key to success is decisive action. Irrespective of how long the business will remain in the portfolio pre-exit, once a business has been identified as non-core, there must be a switch from strategic management attention to value protection. And just to contextualise this, if we look at the chart on the slide and how the red line, business value, moves in relation to the blue line, management attention. When a business is in that early stage of development, it requires a high degree of management attention. And the payback for this is the increase in value generated. However, when we reach point A, when the business is designated as non-core, we often see scenario B. Management attention completely moving away from the non-core business to focus on core activities. Now, this can lead to the target losing momentum, a deterioration in performance, and often becoming underinvested. This in turn has a significant impact on value, the red dotted line B. In this scenario, not only is there a high chance that the exit value is reduced, but it also is likely to lead to a lack of buyer engagement and jeopardise the ability to exit the business through a sale. Now, the converse is true in scenario C. With an element of sustained management attention, focus on value creation pre-exit, the value of the business can be maintained, as too are the chances of delivering a successful deal. So I'll now hand over to Graham and Philip to take us through in more detail our recommended approach to divestments.
Thanks, Nick. And as Nick mentioned there, a lack of focus from group management can cause value to be lost. This point of focus is critical in maximising value from non-core divestments. In this next section of the presentation, we're going to share our perspectives on how to maximise this value and increase deal certainty. These perspectives have been developed from our experience working on this type of transaction. We see there being three key stages of preparation for non-core divestments. First, there needs to be an assessment of the business in order to set the exit strategy. Once this strategy is set, it can be used to guide the development of a divestment business plan that incorporates profit improvement measures and is prepared in a way that it matches either a group sale or a breakup sale. Time-critical carve-out steps should also be actioned. And finally, with the business plan in place and the carve-out preparation in train, an exit readiness exercise should be undertaken so that the business is as clean as possible ahead of the sale process itself. The aim of all this is to make sure that the equity story is clear, Current profits are improving at the time of the deal. The future profit opportunity is clearly articulated, and the carve-out plan can be understood by buyers. Boosting profits and taking steps to ensure the business is as attractive as possible can increase both aspects of the value equation to maximize the outcome. So if we move on to the next slide now, we'll look at the first phase of the preparation process, and this being to complete a deal assessment to establish the industrial logic for an acquisition and to set the exit strategy. This assessment is carried out in 3 steps. The first, here on the left, is to focus on the business itself. This includes a market review just to understand the overall industry drivers, what's the pricing outlook, margin evolution, the balance between supply and demand, the competitive landscape, what's the competitive position of the business, its market share, and what are its competitors doing. So overall, will the market context be positive or negative during the process? Then an operational review to identify the likely improvement areas, cleanup opportunities that can be addressed, red flag risks around typically IT, legal or regulatory, and then what are the interdependencies with the group that can influence the carve out. All of this to really understand, where do performance improvement efforts and carve out planning need to be focused. And finally, in this first step, a financial review. How do you understand the performance of the business by segment or division? Should the business be presented by company, by region or by product? Are there any problem areas that could drain value, for example, onerous contracts or loss-making parts of the business? And then, as Nick mentioned earlier, the identification of any surplus assets that might not be valued by buyers where value could be realised in addition. What is the story really that the financials tell, and what are the issues that need to be ironed out? Step 2 is then to assess the business in the context of potential buyers and how they will look at value. What's the buyer landscape, and the key being really to assess the likely interest of strategic buyers, as they will typically pay the highest price. What are they most interested in? And would it be for the whole group or specific parts? Are there any buyers for niche parts of the business where high multiples could be paid that might be overlooked by group bidders? And then what are the potential synergies available, both on costs and revenue? A valuation assessment can then be completed in order to understand total value, and then what potential upside could be achieved from a breakup sale. Step 3 is finally then to look as to whether the ideal sale perimeter is feasible. Is the breakup premium sufficient to offset the costs and risks associated with it? A high-level carve-out review for the separation from the group should be completed so that critical path items can be identified. And if a preferred route is a breakup, then a fallback sale perimeter should also be determined in case this cannot be delivered. Once the exit strategy is set and the understanding is gained as to what buyers will focus on, this knowledge can then be used to guide the development of the divestment business plan. And with that, I'll hand to Philip.
Thank you, Graham. So, building on the insights developed in the previous phase and the industrial logic validated, detailed performance improvement plans will be created. This whole phase is ultimately around ensuring 2 things. First, that value is not left on the table, and second, that the business is as saleable and as attractive as possible. Starting point is a thorough business diagnostics phase that will scan the entire organization, take stock of already ongoing improvement initiatives, and identify areas of improvement potential that are currently unaddressed. This will then result in 2 different groups of initiatives. There are the readily identified quick hit improvements that can be implemented immediately. These are all about improving profitability right away, creating a positive momentum in the performance of the business, and bolstering the value of the entire asset prior to the launch of a sale process. For longer term improvement opportunities that require more management attention, a detailed roadmap to delivering the improvements must be developed. And these initiatives can then either be implemented prior to sale or incorporated into management business plans and sold as part of the upside to the new owner, making the asset a more attractive prospect and the entire sale process smoother and quicker. So the question is now, how do we make sure that all these initiatives and improvements get reflected properly in the sale process? Let's move on to the next step to have a look at how to build the business plan. So the way this is approached conceptually is by taking the original business plan as a basis, which is sort of a do-nothing scenario, and then overlaying or stacking up the identified performance improvement initiatives to form what we call the full potential divestment business plan. Why is building this business plan so important, and why should a seller not simply stick with the original one? First, it helps keep track and stay in control of all the initiatives identified in the previous stage. Building it into the business plan puts it on the radar and gives clear priorities for management. Second, the business plan will be made available to the buyers during due diligence. It will be the starting point for any of their financial projections and is therefore directly linked to the later valuation of the business. It drives the sale process. And finally, it helps to build confidence on the buyer side, because the signal the seller is sending is that they have done their homework, they are prepared, and the business is actually ready for the sale. Consequently, the outcome of this phase is very critical to the overall success of the sale process. Now, we have looked at capturing improvement potential and building the business plan, and the next step is about developing a carve-out framework. Let me take you to the next slide for this. So the aim of this phase is to identify the key separation activities that are required to decouple the target from the group across all geographies, legal entities, product groups, and functions in scope. The key to this is that the framework will lay out all important critical path items and interdependencies. So those that you will have to resolve for any type of buyer, either strategic or financial. However, the further into the sale process, the more clarity there is about the shortlisted buyers and their specific interest into the asset. For example, a corporate buyer who will integrate the business might not be interested in certain product groups or production plants, as there are no synergies to be expected, or even worse, dyssynergies are a threat. So you would take these out of scope. Whereas for a private equity buyer, it might be a requirement to have a standalone and up-to-date IT landscape in place, which has to be fully disentangled from the group. So you would put significantly more focus on this. Summarizing, the main message about planning the carve-out is all about starting from a high level, and as the sale progresses, fine planning becomes more important. This way, it will provide confidence to the buyers that the carve-out has been thought through end to end, and that ultimately increases deal certainty. And with that, Nick, back to you.
Thanks, Philip. The final stage of preparation is exit readiness. Now this stage takes place once the preferred launch date for the sales process has been agreed, and encompasses all areas of activities required to deliver the sales process. It includes identification of any outstanding risks to be addressed, a full commercial and legal review to ensure there's no showstoppers, confirm the buyer pool, build on the synergy assessment carried out in phase 1. Critical is also a review and challenge of the business plan, not only to ensure it fully reflects the performance improvement initiatives, both that are underway and in the pipeline, but also to ensure the business plan is robust, will stand up to due diligence and fully reflect the potential value of the business. Now, the objective of this stage is to provide the tools and the framework required to deliver a sales process, free from surprises, build buyer confidence in the business, and enhance value and avoid delays, whilst at the same time minimising disruption to the core business and management distraction. So to draw out the benefits of this pre-exit assessment, The next slide provides a useful way to look at how value can be developed throughout the sales process. I like to think of it in 3 stages. Firstly, establishing value. The baseline for valuation expectations reflecting the full potential of the business on a standalone basis. Secondly, enhancing value, both through the identification and securing value for potential synergies a buyer may enjoy, but also creating competitive tension between bidders to push up that bid offer. The final stage of the process is focused on defending value, and this is achieved by running a robust diligence process. In addition, we look to seek to secure further value through negotiating hard on working capital, debt-like items, or some of the more subjective areas. Together, ultimately, this will lead to the value achieved for the business. So whilst today we focus on the preparation stage of the process, you can see that by investing time up front, it provides the critical building blocks to deliver a process and deliver value through that process, building momentum to drive the timetable and ultimately deliver a successful sale of the business. Graham, I'll hand back to you now.
Thanks, Nick. So in conclusion, the M&A market is recovering, but it remains subdued. Whilst there's a lot of dry powder in the market, particularly with private equity, deal timetables are being drawn out and investors are being cautious, and therefore transactions are subject to greater scrutiny. So this means that it's more important than ever to prepare before bringing a business to the market. In our experience, this means that the industrial logic for a deal needs to be understood and the complexities of a carve-out addressed in advance. But there also needs to be a laser focus on profitability. Implementing the quick hit actions to boost profitability has the added benefit of enabling the business to be sold with positive momentum, which is so important. A robust plan to deliver longer term profit growth also increases the likelihood of securing value for this rather than it simply being numbers on a page. Timely, decisive action and the implementation of a structured divestment preparation plan can ensure value and deal security is maximised. So thank you all for your time today. We really hope that you found the session informative and helpful. If any of this is particularly relevant to situations you're facing now or in the future, of course, please contact us and we'd be very pleased to help. Thank you.